Hello and welcome to the Options Doctor Stock Options Trading course. In this section, we're going to be covering all about options. Taking a look at options. Exchange traded options first started trading back in 1973. Although they have a reputation for being risky investments only expert traders can understand, options can be useful to the individual investor, retail traders like you and me. Many investors have avoided options, believing them to be sophisticated and therefore too difficult to understand. Many more have had bad initial experiences with options because neither they nor their brokers were properly trained in how to use them. The improper use of options, like that of any powerful tool, can lead to major problems. Finally, words like risky or dangerous have been incorrectly attached to options by the financial media and certain popular figures in the market. However, it is important for the individual investor to get both sides of the story before making a decision about the value of options. All about options. Some of this is going to seem repetitive and redundant, but I promise you it's for your benefit. We're going to dive a little bit deeper and divulge in some of these concepts that we've maybe gone over prior, but we're going to get a little bit deeper in detail. So when we're talking about calls, the best way to recognize or identify and attach the idea of a call option is to say, call up. When you are looking to buy a call, it's because you're hoping or afraid that the stock price will go up. So again, maybe you're afraid that it's going to shoot up and you're not going to be able to take advantage of the current price that you bought in prior, or a lower price. So you're afraid it's going to shoot up, so you buy a call in case it does. You can exercise that option and go back and buy it at a cheaper price. Or you're hoping it's going to go up, and so you want to take advantage of the price move in the upward direction. Put down, you want to think, because you're wanting to buy a put because you're hoping or afraid that the stock price will go down. So again, you're hoping it'll go down because maybe you want to take advantage of a downturn in the stock. You're betting against it, or you're afraid the price will go down because you have the stock and it's done well, but if it happens to dip in price, you want to be able to sell it or let it go at a higher price than where it would currently be trading at if it were to turn around and drop in price. So buyer or holder and the owner are the same, and you pay the premium and you're in control of the option contract. Okay, so a seller or writer or grantor is the same thing, and there you receive the premium and you take on an obligation. Okay, when you sell or go short an option, you create an obligation. A put obligates you to purchase the stock that is put to you, and a call obligates you to sell the stock, which is called away from you. Okay, so this is when you sell or go short on an option contract. You're creating that obligation to either purchase or to sell. Okay, when you buy a call, you're going long, and when you sell a call, you're going short. When you buy a put, you're going long, and when you sell a put, you're going short. So it's good to understand that. I know in the previous section we talked about short and long and what that meant. Well, here's a little bit better understanding or breakdown of it so you can really grasp the concept, because I'd like for most of you guys to be advancing into learning how to take advantage of both calls and puts, so you can make moves in both directions of stock price action. Covered means the stock is owned. Uncovered or naked means you don't own the stock. So you might hear people talking about selling, naked, or buying naked calls, or selling naked puts, things of that nature. That just pretty much means they don't own the stock. If it's covered, that means you own at least 100 shares of the stock, so that if you were to get exercised or assigned, you wouldn't even have to come up with the cash to go buy the 100 positions at that strike price. You already have the stocks in your portfolio, and you could just exchange those. Okay, either sell them or give them to someone if you were assigned or obligated to give away or sell away those, or if you were obligated to purchase or put those to you, you'd already have it there in your portfolio or your inventory. So the best way to hedge against losses on a short sell is to buy a call option. Okay, so if you're selling short a stock, the best way to hedge that position is to buy a call option. Okay, only the owner can exercise a contract. So that means that if you're the owner of that contract, only can you exercise it. If you're selling it, you're not the owner, so you can't exercise the contract. You can be obligated to either buy or sell it, but you can't exercise it. Only the owner can do that. A long call, which is bullish, your break even is going to be your strike price plus the premium, and your max gain, which I know we talked about knowing your max gain, max loss, and break even. So here we're going to dive a little deeper into that. But here your max gain is unlimited on a long call, and your max loss is the premium paid. So the most you can lose is what you pay for that option. A short call, which is bearish, your break even is the strike price plus the premium, and your max gain is the premium taken in, or that credit that you receive. Okay, and the max loss is unlimited. It can be unlimited because if the stock moves in the opposite direction, you're going to be in a really bad situation, especially if it's just continually going up and you were expecting it to be going down and be able to buy it at a lower price. You're going to be in a really bad situation if it just continues to go up, because that leaves you at an unlimited max loss. As high up as that stock would continue to go, you'd be at a huge loss. Again, unlimited. When you short an option, the max you can gain is the premium you pocket. Okay, so when you're shorting that option, the max you can gain is the premium, or that credit that you collect, the money that's being put into your pocket. So a good strategy, something I've done before, you can short an option and you get maybe 10 contracts. A lot is 10 contracts. And when you get a lot or 10 contracts, you're taking in, let's say, maybe $1,000 a contract. So you pocket 10 grand. But there's caveats to that, because you want to make sure the stock moves in the right direction so you can keep that money that you pocketed. Otherwise, sometimes you might have to come up with the actual stock being assigned or exercised on that contract, and you pretty much subtract the difference from what you pocketed and what you had to pay for the stock you were obligated to come up with, because again, shorting an option, you create an obligation. Long call, you want the price above break even, and short calls, you want the price below break even. Okay, if you're the buyer of a call, the max gain is unlimited, which is obviously why a lot of people, I think, are more bullish starting out trading options in stock, period, because when you're long a position like that on a call, the gain is unlimited. Okay, if you're the seller of a call, the max loss is unlimited. So again, you might have heard me state in the earlier lessons that this is a more advanced strategy. Yes, for that particular reason, because if you're the seller of a call or an option, period, there's an unlimited max loss. Break even is the same for both buyers and sellers of a call. Okay, put owners pay a premium for the right to exercise and sell shares at the strike price. So again, when you're the owner of a put, you're given the right to exercise and sell that stock at a higher price, that strike price, which should be higher than the current trading price of the stock. That's the purpose of the put. The put seller receives a premium and will incur an obligation to buy the shares at the strike price if the contract is exercised or assigned. Okay, so again, you're creating an obligation when you sell that put, and you're then obligated to buy the shares at a strike price selected if that contract is exercised or assigned. So either you're pocketing that premium and you're hoping that it expires worthless and you get to keep that money that you pocketed for selling it. Or maybe you want to get the stock at a lower price, so you sell that put, and that's why this is bullish, because if you sell that put, then you're saying, look, I'm expecting this stock to eventually go back up, so I'm trying to get myself to purposely be assigned or exercised to buy it at a lower price, that strike price you selected. So puts are the opposite of calls. Hopefully we've gotten that and understand that by now. A long put is bearish, and the break even is the strike price minus the premium, and the max gain is your break even to zero. Your max loss is the premium paid on that contract. Okay, so the most you can lose is what you paid for the contract. And again, that max gain is going to be break even to zero, because that break even is your strike price minus the premium. So if the stock were to go to zero, obviously, you'd be in a great position because you could sell it much higher. So that's why your max gain there is break even to zero. It's that strike price minus what you paid, and then up to zero. Okay, it's not like a call where if you're long on a call, it can just be unlimited, because if the stock price goes to zero, there's nowhere else to go. You can't go any further. Okay, so long puts, you want to see the price go below break even. Okay, so that's why, again, your max gain would be break even to zero. So break even and anything below that all the way up to zero is as far as you can go. Short put, which is bullish, your break even is the strike price minus the premium. Your max gain is the premium, which again, that's what you're receiving. It's that credit. So the max you can gain when you're selling or shorting a put is the premium that you collect. Okay, that money that's pocketed, that's given to you for initially selling that contract. Your max loss, again, break even to zero. Okay, short puts, you want to see the price go above break even. Okay, so with a short put, you want to see that price get above that break even, which was the strike price minus the premium. Okay, break even is the same for buyers and sellers of a put. If you're the buyer of a put, the max gain is the strike price minus the premium. If you're the seller of a put, the max gain is the premium paid. Okay. If you're long a stock, then you would want to buy a long put or sell a short call for hedging and protection. So that's if you own the underlying stock. You actually own the stock position and you're wanting to protect or hedge that particular position. You'd want to buy a long put or a short or sell a short call to hedge and protect that position. If you're short a stock, then you would want to buy a long call or sell a short put for hedging and protecting that underlying security, okay, or that underlying stock position. Buying an option on the stock gives you the best and most protection. So I know we talked in the beginning about people mentioning options are risky and dangerous. Well, again, if you know what you're doing and you understand how to utilize options, whether you're flipping them or actually using them to hedge and protect, it offers the best protection and the most protection you can get on your stock positions. And lastly, selling an option gives the opportunity for income from the premium taken in on the sale. And that's a great strategy if stock is moving sideways or maybe even moving down, and you've got a portfolio. A great way to create some income within that portfolio is to sell an option, and it gives you income from the premium taken in or that credit you receive for selling those option positions. Be sure to subscribe to the Options Doctor on YouTube at the Options Doctor. Make sure you turn on notifications and like our videos for helpful tips, trading strategies, and new content. Also, follow us on Facebook at The Options Doctor and on Instagram at The Options Doctor for updates and unique content. Also, we would love for you guys to share any of your profit successes with the world as a part of our growing community. And we ask that you send those on the Discord or on one of the social media platforms. And we'd love to share your successes as a testimony to what we teach and how we help to develop new options traders. Lastly is due diligence. As we stated before, you don't want to take anyone else's word, advice, or recommendations without having done your own research first. Our content is intended to be used and must be used for informational purposes only. This is not investment advice. All content in this video is of general informational nature and does not address the circumstances of any particular individual or entity. There are risks when investing. So trading or investing requires risking capital, and we recommend that you do not risk any money that you can't afford to lose. Thank you. We look forward to helping you grow and teaching you about stock options flipping as you embark on this journey in the options trading world.